Hi everyone, I'm Karan and welcome to Karan's Gyan. Today I'll be talking about index futures, particularly more about Nifty futures, and I'll tell you why, if you're betting on futures, why you should bet on index futures or Nifty futures more than betting on individual stock futures. So let's start. Time and time again, I've told you Nifty is an index of 50 stocks. There are 50 stocks in this basket of index, and these stocks represent various economic sectors from petroleum to pharmaceuticals. It comprises of all major sectors in India. As a result, if you want to consider an overall market, you know you'll see Nifty represents the overall market better than individual stocks, because individual stocks would represent only that sector. If you have a TCS stock, TCS is an IT company, Tata Consultancy Services, and Tata Consultancy Services futures would just represent the IT industry. They won't represent the overall prosperity of the economy. So if economy goes up, it doesn't necessarily mean that TCS futures would also go up. However, if economy goes up and you've got Nifty index futures, you have bought Nifty index futures, your Nifty index futures are likely to fare better because Nifty represents the overall economy. Yeah. So it naturally means if general economy activity is going up, Nifty's value is also expected to go up. So, trading Nifty futures makes it better than trading stock futures. All right. So I'll give you seven reasons. Give you seven reasons of why you should choose to trade Nifty futures than trade individual stock futures. First is diversified. Nifty is a basket of 50 stocks. So, if you want to take a directional call on the prosperity of the country, it's better to invest in Nifty futures. It's better to bet on Nifty futures, as I would say correctly. As I've told you, for example, you've got Infosys Limited, which is another IT company just like Tata Consultancy Services. So, if Infosys has a bad quarter, whereas the overall prosperity of the economy is increasing, Nifty futures would actually increase, whereas for having a bad quarter, Infosys future would be hammered. Second, hard to manipulate. Nifty futures are really hard to manipulate because they are a basket of 50 stocks. So these 50 stocks have to be manipulated for Nifty to be manipulated, and you'll need a lot of money for that manipulation because these stocks are extremely well capitalized stocks. There are lakhs of crore rupees that have been invested in these stocks, and you'll need thousands of crore rupees to manipulate these stocks, and in turn you'll need thousands of crore rupees to manipulate the index, whereas you can manipulate individual stocks that don't have much market capitalization. uh, these are also called operator plate stocks. So at times you'll see some stocks have been hitting upper circuit, have been increasing every day for the past 6 months, and suddenly they start falling. So these are operator plate stocks. As a result, if you buy operator plate stocks, you can get trapped in the market. So Nifty is not an operator played index. It is not possible for Nifty to be played. Of course, I told you Nifty is rigged in the previous videos, but it doesn't mean that Nifty is manipulated. Nifty is rigged in its own sense based on weightage, like index weighted, because of how weighted average is taken, how index is calculated. Based on that, it's rigged. It's not rigged in the sense that it's manipulated. Since there have been previous stocks like Bhushan Seal, Satyam that have been manipulated, and their shares have been like going like a circus in the stock market, up and down. So you can't manipulate Nifty. You can manipulate individual shares. Second is highly liquid. These are highly liquid contracts. You know, I haven't talked about liquidity, but just so that you know, liquidity is is something that is, like, it can flow easily. What is a liquid? Liquid can flow easily. So what I mean by being liquid is, if I buy a share and if I sell a share, I'll have no problem in either buying the share, or I'll have no problem either selling the share. It's like water. It'll come to me like water, it'll go away from me like water. That is what I mean by liquid, you know. So Nifty is highly liquid. You can literally transact any quantity of Nifty without worrying about losing money on impact cost. So impact cost means, if I start buying something, for example, if I start buying apples, if I start buying some apples, the apple cost may not go high. But if I start buying a lot of apples, technically the demand for apples is increasing and the supply of apples is the same. As a result, me buying a lot of apples can be a signal to the market that I'm increasing the demand of apples. And as a result, since the demand is increasing and the supply is same, there can be an impact cost of apples. I might be able to buy the first kg of apple for 10 rupees a kg, and the last kg of apple for maybe 20 rupees a kg. So this 10 rupees is an impact cost. My surplus demand in the market has impacted the price of apples and mine. So with Nifty, it doesn't happen. You can buy as much Nifty as you want. All right, and you would not have any impact cost. You'll be able to buy all the Nifty futures you want to buy at the price it's quoted. You buying Nifty futures, it will not impact the market. The market will stay the same. You're not increasing the demand. There are a lot of contracts of Nifty. Next is lesser margin. Time and time again, I've told you, margin is related to volatility. High, more volatile a future, higher the margin. And Nifty 50 is Nifty futures specifically, they require less margins compared to individual futures. It is because Nifty is less volatile. Yeah, it has less volatility, and you need, a margin of 12 to 15% of contract value. However, some individual stock margins can go up as high as 45 to 60%, because they are much more volatile than Nifty. Nifty is very stable. If you are a trader and you've noticed how Nifty, like, fluctuates between levels, you'll see Nifty is really calmer compared to the rest of the market. There's not much fluctuation, there's not much variation, and there's not much volatility. Hence, you see lesser margin. So you can leverage yourself more. If you think Nifty is going to go up, you can leverage yourself more and you can earn more money. I've talked about leverage in the previous video. Mm. Broader economic call. Like I said, if you're betting that the GDP numbers are gonna be better than what people expected, you can take a broader economic call. If you think the job data is better than what people expected, you can take a broader economic call. You can buy Nifty futures because you think the overall conditions of the market of the country are better than what people expected to be. Similarly, if you think that the job data is going to be less, and there'll be more percentage of people unemployed in this quarter compared to the last, and you feel the market is wrong and expecting that you will get a positive job data, so you can short Nifty futures, you can sell Nifty futures, you can bet against Nifty futures. So trading Nifty futures requires one to take broad economic based call rather than company specific directional calls. From my experience, doing the former is much easier than latter. So it is much easier to know about the overall prospects of a country than knowing the overall prospects of a company. Application of technical analysis. So the point of betting in futures is technical analysis. 50% to 80% of the traders, they bet in Nifty futures, index futures, mainly because they notice a trend, they notice a technical chart, they notice the technical chart and they see, all right, the technical chart says that the future is going to be bullish, index futures are going to be bullish. As a result, they'll use technical analysis Personally, I don't do much of technical analysis because at times they do well and at times they don't do well. However, technical analysis especially work very well for liquid instruments. They don't generally work well for illiquid instruments. They fail when instruments are being manipulated. So since Nifty is it is a liquid instrument, it is hard to manipulate. So you can use technical analysis better. Actually, technical analysis is based on demand supply dynamics. Yeah, and since Nifty futures are liquid, they are hard to manipulate. Their demand supply dynamics are true to what is being depicted. Less volatile. As I've said earlier, the margin of Nifty is less because they're less volatile. And how I've discussed on how margins and volatility, how they both are related to each other. So less volatile in futures would have lesser margin. To give you a perspective, Nifty futures have an annualized volatility of 16 to 17%, whereas individual stocks, say Infosys, has annualized volatility of upwards of 30%. Now you see, margin of Nifty futures is 12 to 15%, and annualized volatility of Nifty futures is 16 to 17%. That means they are pretty much 1 is to 1 correlated, and this is what happens in the real market. They are more or less between 1 to 1.2%, 1 to 1.2, uh, you know like they're between 1 to 1.2 ratios. So generally, as much as the analyzed volatility is there, you'll have pretty much that much margin. So if the analyzed volatility is 16 to 17%, your margin would approximately be the same, 16 to 17%. But there's a calculation behind it. That calculation is for some other day. It's a pretty complex calculation. It is a pretty long calculation. Also, it has a lot of roots, a lot of high end terms, mathematical terms, some integral, some differential. It uses basically a rocket formula in it, and there are a lot of things they consider in calculating the margin. Well, guys, this is pretty much it about Nifty futures. If you guys have any questions, please give me a comment and I'll get back to you as soon as possible. Have a nice day. Bye.